It's 4 p.m. here at DBS Asia Central in Singapore. I am Timur Bek, Chief Economist with our Economist for Singapore, Chua Han Teng. Hi, Han Teng.
Hi.
Welcome to yet another month of Macro Insights Livestream, Han Teng.
Yes, time fly past quickly.
Indeed, and there's a lot to talk about. There's so much to talk about, not just about the global context, but also the area of Han Teng's specialty, which is Singapore, that we decided we'll split this presentation up into two bits. First, I will talk about the big elephant in the room, this month's Fed meeting and what that means for the global economy and the markets going forward. Of course, we're going to touch upon that, hopefully in a slightly innovative way, not the cookie-cutter way that you are familiar with from the rest of the market's discourse on this issue over the last month or so. And then, Han Teng, in your section, you're not only talking about the Singapore economy, but also touching upon the balance of payments, some idiosyncratic aspects there, and maybe a couple of slides on the Prime Minister's National Day address?
Yes, I'll just conclude with one slide on the Prime Minister's first address at the National Day rally, which is quite insightful.
And a few markers for structural reforms for not this year, but for years to come.
Yes, and that would sort of be in line with his Forward Singapore agenda.
Right.
That's being
right,
laid
indeed. And you know, I think we alluded to the study that Han Teng and I were part of, along with Radhika Rao and Ma Ting last month, which I think in the last live stream we shared the QR code, which is the Southeast Asia 2024-34 report. Han Teng, even there, we talked about the likelihood that the coming 10 years will be better for this region than the last 30 years, including for Singapore.
Yes, certainly. I think we are quite optimistic for the region. I think there are different things that are going on that's good for them. The China plus one diversification that's happening is one that is quite exciting.
So we've certainly talked about China plus one in the past. We'll do so in the future. I have a feeling, Han Teng, you'll be back here in 2, 3, 4 months' time to talk about the Johor-Singapore SEZ.
Yes, that's something that's quite exciting and developing quite fast, and we should be hearing quite some announcements later this year during the Singapore-Malaysia retreat.
Correct. I've heard already quite a few things from the Malaysian side. I'm looking forward to seeing the things that the Singapore side announces in the coming months.
Yes, certainly.
Right. So, Han Teng, you'll be back a little later. Let me go over my slides looking at the markets and the Fed.
Yes, so, I'll join you later on.
Very good. See you soon. Okay, so let's get the slideshow running. But first thing first, as usual, we have an avenue for you to send in your questions. On the screen, you can see the QR code that you can scan and join Pigeonhole to send us some questions. We already have a few. I just checked. And if you have a problem scanning the QR code, you can certainly just type dbs.pigeonhole.at and they enter the password macro. If I said all of those things very fast, don't worry. That slide will be back at least a couple more times during the course of this afternoon. Let's get going. Markets and the Fed, I will cover that. Singapore outlook with balance of payments and policy direction. Han Teng will go over that after I'm done with my slides. So I want to start by talking about a bit of a stock-taking exercise. The risk environment is benign. Why? If you look at how things are right now versus they were at the beginning of August, it's been 5 weeks. It's come down again. So basically, the early August sell-off and volatility was a very, very small episode. And since then, things look more or less the way they did before August came to us. So vols have sort of dissipated to the pre-August levels. The dollar sell-off has been orderly, nothing major happening in the market. And I think that's because there have been a series of anxieties in place for 2024 and beyond, which so far have not materialized. In fact, if you can recall, at the end of 2023, the narrative was 24 was going to be the year when high inflation kept rates high for a very long time, and that would then feed into companies with leverage struggling to pay back their debt, credit risk would rise, growth would slow, the Fed would struggle to cut rates, and then the market would sort of go on strike against that. All that fear has proven to be unfounded to a very large extent. Take, for example, inflation, the one box slide that I have on the screen right now. Anxiety about sticky inflation was there, then it sort of spiked up a little bit in late December 23, early 2024, but since then again has faded. I have two measures of trimmed down inflation, so to speak, on the screen right now. core PCE, the Fed which watches that more closely than any other measure of inflation, but also another one that looks at headline measures, gets rid of the most volatile items as opposed to just looking at specific items, and then creates what is known as a trimmed mean Fed. The Kansas City Fed, the Dallas Fed publishes that data. You look at both of them. I think you can choose to look at them in their totality or in their isolation, but both tell exactly the same story. Inflation peaked more than 2 years ago. Since then, it's been gradually coming down with some noise, which has forced the Fed to keep rates high for a while, but it is certainly going in the right direction, giving the Fed confidence about cutting rates in the very near term. There was also fear of hard landing of the economy. I can think of many of my peers in the industry who have been calling for recession since the middle of 2023. Thankfully, that has not materialized. We don't want those forecasts to be true, even if those are our forecasts. We were not in the recession camp, but nonetheless, it is worthy to know that there were a lot of fears about recession. And if you think about the data surprise chart that I have on the screen right now, in conjunction with the inflation side, it shows that in the summer of 2023, there was actually quite a bit of fear about growth beginning to tumble. But since then, data surprises actually turned positive. Through the course of this year, say from April onward, April to August, there has been some accumulation of downward surprise. Nothing compared to the ones that we saw in 2023, but there has been some downward surprises. That itself has bottomed out. And if you look at the last few weeks' data, maybe a month of data that we have, things have actually turned around. Case in point, US GDP nowcasting, right now it's again, as we speak, is tracking the US economy at plus 2.5% growth. That is not the sign of an economy about to tumble over or about to go into recession. So you will hear us talk about labor market weakness. You will hear market participants talk about labor market weakness. The Fed will talk about labor market weakness when it meets later this month for its meeting. But you need to think about what is actually happening with respect to consumption, public spending, investment, looking still pretty good in the US, not looking bad at all in Asia. And in Europe, marginal weakness, but again, everything on the margin. There is no substantive downshift of economic momentum anywhere. What else is there about the risk environment? So volatility. So what I have on the screen, actually it's hard for me to explain this chart in a small period of time because it entails explaining Black-Scholes formula. But the bottom line is that it is a measure of skew or volatility in the market. When this marker goes up, it means that there are more puts on net basis in the market than longs, and therefore than calls, and therefore people are more inclined to selling than buying. And that, of course, picked up substantially about 4.5 weeks ago. It's come down substantially. So corroborates the point that I made at the very beginning of this presentation, which is vol markers are basically back to pre-August levels. In fact, we have seen numbers like this all the way going back to 2023. And then the other way of looking at market anxiety is credit spreads. If you believe that high rates are going to start to burden borrowers, you would start demanding higher spreads on the corporate issuances out there. Do we see that? Well, not really. Corporate spreads on the high yield side, this is US dollar, US corporate high yield we're talking about. We saw spikes around the pandemic. We saw spikes around the taper tantrum back in 2013, and then also around some consternation in the market in 2016, right after Trump got elected. All of that is significantly higher to anything comparable to the spike that we saw last month, and even that has come down over the last few weeks or so. And that is the high yield risky space. If you look at the investment grade space, there's been barely a blip. You have to squint pretty hard in that red line in the chart to see where that volatility or unrest was in early August. So credit market, no issue. So anxiety around inflation, anxiety around growth, anxiety around market volatility, as well as credit spreads. All four of those areas we can say largely behind us or fairly stable, in good place right now, nothing particularly worrisome. Then there's, of course, the issue around China. This whole year, not just this year, but previous years as well, we have been getting used to just worrying about China. What will happen to the property market? What will happen to the currency? What about capital outflows from the country? Even if there are strong laws preventing it, are there invisible or not quite visible ways money is flowing out of China, putting the currency under pressure? What is the latest salvo that the West is unleashing over China on trade wars? all that stuff, made us, very cautious about China. As you can see in this picture that we have, which is the deviation from the RMB from the daily fixing of the PBOC, it's a very useful marker to see whether the currency has buying pressure or selling pressure. Well, if I had come to you anytime since August of last year to now, I probably most of the time talked about selling pressure on the RMB, but not anymore. Now that the market is beginning to price in rate cuts, expecting relent from the Fed, the strength of the dollar has begun to dissipate, and that is, of course, great news for emerging market in general, including China, where the RMB now is seeing actually buying pressure as opposed to selling pressure. As we speak, this is the 11th of September afternoon Singapore time, the yen is heading toward 140. I think it went below 141 momentarily earlier today. So that again tells you that not just the EM space, but also the DM space, by and large, there's a short dollar environment beginning to surface, and that is good news. That is good news because the rest of the world, which doesn't have the luxury of printing US dollar, a weak dollar is good news. Strong dollar creates a lot of problems in terms of invoicing of goods, in terms of competitiveness, because things are set in dollar prices. When dollar starts to weaken, the ability to maintain competitiveness, ability to hold on to your exchange rate with a lot of selling pressure improves substantially. So a big sigh of relief as far as central banks and market participants are concerned outside of the United States. China also, the credit story is an important one. Earlier we looked at US investment grade and high yield credit. Now let's look at what's happening in China. We have the 5-year corporate AAA spread from China government bond, as well as 5-year corporate AA CGB trend. You can see that there's been actually a big rally as the PBOC has cut rates and eased policy. So yes, we do worry about the property market. We do worry parts of Chinese financial sector where debt repayment is under a lot of stress, where restructuring is required. But if you look at the totality of the measures that the authorities have pushed through this year, individually, they tend to underwhelm, but in their totality, it's a lot, and it is beginning to have an impact. It is easing liquidity, it is pushing down interest rates, and it is helping spreads. So then again, the large quantity of concerns that we have on China are probably well justified, but the matter is not taking place in isolation without any policy reaction. So there's an endogeneity to this. We worry about China, the market worries about China, the authorities take supportive measure that then allays some of the concerns, and that's what we're seeing, whether it is the RMB or the credit space. All right, so those were a set of slides on the risk environment and how things are actually much better than a panic-stricken analyst who's worried about recession risk would like to assert. Things are actually way better. So what's the state of the global economy? Well, first chart, the story around quantitative tightening and policy rate increases. So what you have on this chart are 4 major central banks of the world: the Fed, BOE, Bank of Japan, and ECB. So, Bank of Japan is special. They still have the rates on the floor, just a little marginal increase. But other than that, they are where they have been for a very long time. But they're, of course, talking very loudly about normalizing policy, which is why the yen is beginning to appreciate. But of course, the bigger story for the yen or for any other EM currency is the fact that the US has held rates flat for a while and is planning on cutting rates soon. From a quantitative tightening perspective, some liquidity has been withdrawn. If you scale central bank balance sheet to GDP, it is almost back to where it was in the pre-pandemic levels. I did a podcast with GIC's chief economist, Prakash Anand, last week, and Prakash said that he doesn't like to use central bank balance sheet as a share of GDP. He would much rather use something that is more relevant for the banking system. For example, central bank balance sheet as a share of bank assets or bank loans. And there, the view is that the liquidity is even more ample, because loan demand has not been very strong in this cycle. So whatever liquidity injection that the Fed has done, a lot of it is sitting very idly and creating a great deal of buffer for the market to breathe. We are nowhere close to going into uncomfortable territory as far as liquidity is concerned. So rates will come down. A little more QT will continue, perhaps all the way to the summer of 2025. But we don't see either of those things, whether the Fed cuts a lot or not, does not cut a lot, or it stops QT in June of next year, or does something even more expedited. We really don't think any of those things really matter that much. The message has been telegraphed very well to the markets. Rates are at their peak. They will be lower tomorrow than today, next quarter from this quarter, and so on. May not go down as much as the market would prefer it to go down, because we don't think it'll be that easy to attain 2% inflation target on a sustainable basis, but it would be much lower. I think I have made this argument several times in the past. The narrative around Fed rate cuts going forward would not be because growth is weakening substantially, it's because inflation has eased substantially. Because if inflation eases substantially and nominal interest rates are unchanged, real rates start to go up. The Fed will cut on account of that. It doesn't want an excessive tightening of financial conditions. It doesn't want to hurt the economy unduly, but it is not doing to fight an impending recession. I think that's where I think there's a gap between where the Fed is looking at the market and where the market itself is looking at the global economy, which is it in dire need of rate cuts? The Fed doesn't think so. Therefore, it will, in our view, be fairly calibrated in cutting rates as opposed to some of the demands from the market, which is, they should cut by 50 basis points this month and maybe another 50 basis points next month. We don't think any of that is happening. At most 50, perhaps 75 basis points of rate cut this year. But our official call remains cut in September, cut in December. Now, the reason why the Fed is going to be able to cut rates, even if our narrative, which is there is no recession, there is no major slowdown, is because inflation is being conquered to a large extent. Not entirely, to a large extent. Now, we talked earlier about the actual core PCE and trim in PCE in the US, which have also come down substantially. But what about people's view of expectation? Can we get some idea of what inflation expectations are, not just in the US, but Europe and elsewhere? So this is where we have this chart on inflation expectation. These are market pricing based, looking at 5-year forward, 5-year inflation swaps. And there we see that whether it's the UK, US, or Europe, inflation expectations are where they were in 2018 or below that. So this is the key measure. If people's inflation expectations are well-behaved, stable, and have gone back to pre-pandemic levels, I think it is time to normalize policy. It doesn't have to be that there's a recession around the corner, but it's that large part of the hard work in bringing down inflation has been achieved. Now we can bring down rates a tad. I think that's where the Fed is going to go. Those who are looking for a massive rate cut cycle might be disappointed, but rate cut cycle is coming nonetheless. And before I go to the story of Asia's trade, one final word. I mentioned earlier about the Atlanta Fed nowcasting tracking US GDP at over 2.5%. We do our in-house nowcasting as well for a range of Asian economies. What do we see there? We see India in real time right now tracking over 7% growth. We see Indonesia tracking over 5%. China below 5, not that great, but for the second largest economy in the world, 4.7. Pretty impressive in my view. So there are two ways of looking at China, not as strong as it used to be, but still adding substantial amount of value addition to the global economy at growing at 4.7. Then you look at Singapore, again, 2.5% plus growth momentum, very impressive. And I think Han Teng will corroborate it when he comes on later on. I think this morning we saw some release about professional forecasters as well as the government, and everybody's looking at plus 2.5% growth for Singapore for 2024. So growth across the board is looking pretty good. All right, talking about looking pretty good, I'm going to sort of conclude my discussion of the state of the global economy by talking about trade. Southeast Asia is in a strong recovery. It was in doldrums last year, but exports have come back very nicely. It was shrinking by 10, 12, 20% a year ago at this time. It's up by 10% plus for most countries in Southeast Asia and North Asia right now. This chart is only about ASEAN, and if you look at the PMI, well over 50, hovering around 51.2 or 51.3 for the region as a whole. Exports close to double digit, but it's close to double digit only because we are taking into account commodity exporting economies like Indonesia, Malaysia, which have been hurt a lot by flat or weak commodity prices. If you look at the electronics exporters, the Vietnamese and the Singaporeans, looking really, really good. If you go away from ASEAN into North Asia, things are also looking very good. For example, South Korea's chart. So in South Korea, exports are up over 10% on a year-on-year basis through August, and the PMI is really hitting it out of the ballpark. The black line over there at 52, and as you can see, it's been climbing. So what's going on there? Well, several things. One is, of course, the whole AI story, demand for GPUs and memory chips and that sort of stuff being very strong. But that's only one part of the story. There's a lot of industrial policy going on in the US and Europe, demand for machinery and parts. Who makes those machinery and parts? Asian manufacturers, so they're also sending those a lot. And there's a great deal of regional demand, even if you take China away, a lot of investment coming into ASEAN, to Vietnam, Singapore, Indonesia. That is also fueling demand for parts and machineries and electronics inputs, and hence all these electronics exporters are doing very, very well. So on one hand, the market is gearing up for rate cuts in the US. On the other hand, here in Asia, we are not even fully normalized from the post-pandemic recovery. Tourism, trade, all those things are finally beginning to catch up. I think Asia has quite a bit of room left to run, independent of what the Fed does, whether it cuts by a lot, good for us. It cuts by a little, we'll be fine too. Okay, we are speaking to you only about 4 hours since the presidential debate between Harris and Trump. I think we can safely say that that debate probably will not change the mind of too many people. The US is very polarized. People who vote Democrat will vote Democrat. People who vote for Trump will probably vote for Trump. The debate won't change it, but I think it's also safe to say that the debate made Kamala Harris look fairly composed, and Trump didn't exactly do himself too many favors. What about the market? Well, even when the market was pricing in about a 70% victory probability of Trump, that was back before Joe Biden dropped out of the election, I was convinced that it was still a 50-50 election. Since then, of course, Kamala Harris has joined the fray, has had a lot of momentum going for her, and after today's debate, we've already looked at the markets. They, of course, are giving her the win as far as the debate was concerned, and the probability of Trump win has come down just a tad bit, but I still maintain that view. It is more or less a 50-50 election. Only a handful of states will decide what happens in this election, maybe Pennsylvania, maybe a couple of Midwestern states, maybe Arizona, nothing beyond that. We can write down the outcome of perhaps 42 states in the US already. It's really the 7, 8 that's remaining, and even there, in some cases, the blue wave versus red wave are pretty clear. It's maybe 3 states that will determine the election. It will remain a toss-up in my view. It would be fairly different in terms of governance, though, as today's debate illustrated, and it is obviously clear from the platform proposed by the Harris team and the Trump team that whether it is inflation, taxes, fiscal policy, trade policy, of course we know very well, view on the US dollar, even view on the crypto, there will be a lot of intervention and there will be a lot of bifurcation between a Harris administration and a Trump administration. Very simplistically speaking, the Harris administration would be a large continuation of Biden's economics, perhaps more focus on middle-class tax credit, more focus on perhaps not necessarily making some of the tax cuts that Trump did, which have been temporary and not making them permanent. I think Harris would do some things like that. Of course, Trump would not do any of that stuff, and he probably will give more support for the fossil fuel industry, maybe reduce some focus on the renewable industry. But again, I don't think those are seismic shifts because the private sector in the US, the states in the US, are more or less in the direction of green transition. I really don't think Trump or Harris changes those things in a very big way. What about the big policy achievements of the Biden administration, like the Build Back Better and the Inflation Reduction Act, these legislations? I don't think they'll be watered down much going forward, even if Trump were to get elected, because those legislation put tremendous amount of money also in red states, not just blue states, and I think that would not be very politically expedient to roll back. Foreign policy, of course, there'll be a lot of differences. Trump will probably be far more aggressive in getting the Russians and the Ukrainians to sign a peace deal, perhaps at the expense of the Ukrainians. Maybe he'll be very, very confrontational with China, or maybe not. Maybe he will just want to deal with the threat of very high tariffs. Things will be more middle of the road, more rules-based, more decorum-oriented with the Harris administration. I think that also is a safe bet to make. Anyway, we'll be talking about this every single month through the elections and perhaps even beyond the elections. All right, so I'm sort of done with my side of the story. Reminder again that there's a QR code there. If you want to send in your questions, please feel free to do so. Or if you can't scan the QR code, type dbs.pigeonhole.at on your browser and enter the passcode macro. And Han Teng, welcome back.
Thank you.
I'm done with my part. Time for you. And once you're done, I'll come back and we'll take some questions.
Sure.
Sounds good?
Sounds good.
All right.
zoom right straight into what we'll cover for Singapore. So I think for Singapore, we'll cover 3 key things today. Firstly, what we are seeing in terms of the economic outlook. Secondly, a key finding from my research piece recently on current account dynamics there. So we'll touch more about the shifts in that space. And lastly, I think in terms of policy direction, I'll mention about the recent National Day rally speech, the very first one by our new Prime Minister Lawrence Wong. So firstly, let me jump right straight into what's happening in the Singapore economy. So I think just looking at the recent data that in terms of the GDP numbers, what we are seeing is that Singapore's growth has started to turn around from the soft patch in 2023. So in quarter-on-quarter seasonally adjusted basis, the economy is actually growing quite reasonably at 0.4% on average in the first half of 2024. And if you think about the same period last year in the first half of 2023, there was fears of technical recession. And we have since then moved on from that narrative, and Singapore's growth is in fact starting to recover. So including and considering the low base effects from last year, Singapore's economy in year-on-year terms actually performed quite well, growing by around 3% year-on-year in the first half of 2024. And I think in 2024, we expect growth to come in at around the 2+ region, 2.7% to be specific, which is also roughly in line with what is that being seen in the MAS Professional Forecaster Survey that is being released today for the period of September 2024. Now, what are the drivers that are behind this improvement in Singapore's growth dynamics in 2024? And for a small and open economy like Singapore, which is also quite indicative of the trade-reliant economies in the region, we really have to look at external-facing sectors. I think for Singapore, some of the external-facing sectors include your trade-related, such as manufacturing, wholesale trade, transport, and storage. Or I think one area that's growing quite rapidly is the modern services sectors. Here, we see that finance and insurance has actually turned around from the weakness that we have seen in 2023 and growing quite decently in the first half of 2024. So a couple of these sectors, including trade-related services such as wholesale trade and transport, has also turned around quite nicely. One sector that has been lagging so far in the recovery is the manufacturing sector, which we'll touch more upon in the next slide. So just looking at the business sentiment surveys, which will allow us to glean into what are companies in Singapore expecting for the second half of 2024, by and large, you can see that these external-facing sectors have quite a positive outlook for the second half of the year, including that for the manufacturing sector. And in fact, the transport and storage sector is the most optimistic of all. Now, looking more closely at the manufacturing sector, and it's really quite an important sector to look at for Singapore, given that it accounts for around 20% of GDP and have spillover effects into your other parts of the economy, particularly your trade-related services. So here we have seen some weakness in the first half of 2024 with the drag coming from biomedical manufacturing. But just looking at the data, although it's in contraction, it's actually well off the lows that we have seen in 2023. And some of the sentiment indicators that we are watching very closely includes the manufacturing PMI numbers, as well as the business expectations survey by the Economic Development Board. So just looking at the manufacturing PMI numbers, they have been in continuous expansion over the past couple of months. And one key thing that struck out to me is that the electronics PMI number is actually leading overall manufacturing. And this is quite a crucial aspect to this recovery. Electronics alone accounts for nearly half of manufacturing output in Singapore. And the fact that you see electronics PMI leading overall manufacturing also means that in the second half, electronics is probably going to be a crucial driver of the overall manufacturing recovery, and therefore allowing the contraction to turn around. And in fact, when we look at the July industrial production number, that's already seeing quite a strong bounce from the contraction in June, and also seeing some strength in terms of electronics, semiconductors. And this is corroborated by the EDB's survey, which shows that the manufacturing overall is quite optimistic. And in fact, the electronics cluster has been the most optimistic cluster among the manufacturing sector. Other sectors such as transport engineering is also quite positive given the ongoing recovery in the international travel and tourism, which should require maintenance on the part of operators in Singapore. And lastly, I think while the biomedical space is a bit weak, what we have seen is that there has been ongoing investments that are coming into Singapore. One example is Pfizer that opened up a plant in July and is really starting to manufacture products, and it should help to provide some form of cushion to the biomedical industry going forward. So other than manufacturing, I think we also really have to look at the services sector, which is also quite an important part of the economy, and in fact was the sector that prevented the economy from entering into a technical recession in 2023. Two key sectors that I'd like to point out here. One would be the finance and insurance sector, which I think given that Singapore is a global international financial center, that's quite an important part of the economy. What we've seen here is that with US financial conditions easing, I think just now Tabor mentioned about the likelihood of the Fed cutting rates. And secondly, I think with US stock market still being buoyant after the temporary sell-off in August, that has seen financial conditions in the US being on the easier side. So that would translate, I think, to Singapore conditions as well. We also seen the SORA starting to ease off, and that should provide some boost to credit demand. In fact, I think loans, according to MAS data, is really starting to bottom up. And I think as global central banks ease monetary policy, that should provide some support to credit demand in Singapore. Secondly, the other industry that probably is quite important to Singapore is tourism. And I think earlier part of the year in March, we have seen quite some boost there in terms of the blockbuster Taylor Swift concert in the first quarter of 2024. Since then, I think we have seen some moderation in terms of foreign tourists coming in the second quarter, but that's really quite seasonal. Going into the third quarter, what we have seen is that visitor arrivals have started to pick up quite strongly, as well as hotel room occupancy rates. And one key reason for that is that China visitor arrivals are making a comeback, especially during their summer break. And in fact, for July, what we have seen is that Chinese visitor arrivals are above the pre-pandemic rate on a monthly basis as of July. And I think August should still be quite robust. And as we are standing now in September, late September, we'll see the Singapore Grand Prix being held in Singapore, and that should spur incoming tourist activities. And lastly, towards year-end, we'll expect tourism arrivals to remain quite positive. So before I wrapped up the first section in terms of the economic outlook, Tamer earlier mentioned about the nowcast. In terms of our nowcast numbers, we still see third quarter being quite resilient, around 2.5, 2.6 year-on-year growth. And that combined with the first half growth of around 3% should allow Singapore growth for the full year of 2024 to recover to around 2.7%. And bear in mind that 2023 has been quite muted at 1.1. So for 2024, I think the outlook is still looking quite optimistic. Secondly, I think I want to touch more about some of the dynamics that we are seeing in the FX space and how that translate to the current account dynamics. So what we have been looking at is that Singapore has faced quite sustained FX appreciation pressures over recent years. One factor has been the FX tightening by the MAS, 5 rounds, in fact, from October 21 to 2022 to combat high inflation, with some success of doing so in recent years. So what we have seen is that the Singapore nominal effective exchange rate has appreciated over recent years after the MAS moved away from the zero slope policy starting from October 2021. But in fact, the FX appreciation pressures have been beyond what is being prescribed by policy parameters by the MAS in terms of the slope, the center of the band, or the width. So the excess appreciation pressures have actually been absorbed by the MAS through accumulation of foreign reserves, which we show here in the chart, that we also adjust for transfers to GIC. So based on the chart here, which is our measure of exchange market pressures, they have seen quite sustained FX appreciation pressures. And really, there are two key factors that are behind this. Firstly is incoming FDI inflows that have been quite robust. And earlier this year, we have actually published a report on that and the implications around that. But more recently, I think we also dive deeper into the current account dynamics and the support from the export earnings. So here we can see that Singapore, is an island nation, even without natural resources, has achieved quite top-ranked current account surpluses over the years consistently. Here we have a ranking of the economies that run current account surpluses over since 2000 to 2023. And we see that China has done well, but Singapore, in fact, has ranked within the top 10 consistently. Even as the current account surplus increased, the rank has actually improved to around 8 when we consider the average current account surplus between 2020 to 2023, which actually, in fact, has been a quite good period for manufacturers such as Singapore. So I think the strong current account surplus and dynamics have been something that has been understood by investors for a long time. Here we see that the current account surplus in Sing dollar terms have been rising. And if we scale in terms of nominal GDP, that has been quite robust, around 18% of GDP throughout 2000 to 2023. But I think just bearing in mind the high current account surplus situation, there are actually certain shifts in a current account composition that we
we can see in recent years. So I think one key thing that is supporting Singapore's current account is certainly its very high goods trade surplus that has been at around nearly 30% throughout the years. But two key shifts have certainly stood out to us. I think firstly, what we have seen is that the primary income deficit has widened during the 2020 to 2023 period on average, compared to the two periods that we see here before the GFC and after the GFC period and before the pandemic. The second thing that stood out to us, I think, was the flip in terms of the services trade deficit to a surplus starting from the 2020 to 2023 period. And we'll look more into this in the next two slides. So firstly, I think just looking at the primary income deficit that's widening, maybe some of you may think that's a concern, but I think in fact that's not really a concern to us and really reflects what is the dynamics that's going on in the Singapore economy. And in fact, I think foreign investments, significant rise in that area is driving the primary income deficit. When we look at the net international investment position of Singapore it's a net creditor to the world. But when we drill down into the direct investments component, what we have seen is that Singapore has consistently registered wider net direct investment liabilities positions. And this has, the liabilities position has increased quite a bit over the course of the years. And I think this reflects two dynamics. Firstly, like I mentioned earlier, Singapore continues to receive quite a lot of foreign direct inflows, which reflects the competitive positioning of Singapore in terms of attracting foreign MNCs to set up their regional headquarters here. And what we have seen is that gross inflows have actually been increasing quite strongly and, in fact, outweighing that of gross outflows. So although I think Singapore is encouraging Singapore companies to internationalize and to build global Singapore brands, the outflows on that front has been relatively stagnant and more effort can be done in that area. And therefore, I think because inflows have significantly outweighed outflows, that has contributed to the wider net direct investment liabilities. And because of that, payments to these foreign companies have resulted in the higher primary income deficit. But this, I think, should be seen as a positive thing, given that incoming foreign investments has been a cornerstone of Singapore's economic strategy and ultimately has a positive spillover on the economy, whether it's to your smaller SME suppliers or transfer of innovative technologies and in terms of research and developments. So the second development that we spotted in the current account was the rising services trade surplus that flipped into a surplus starting from the period of 2020 to 2023. But in fact, I think this trend has been ongoing for some time, that services trade growth has significantly outpaced that of goods trade growth. Even though in terms of value terms, goods is still much higher than services, but Singapore is evolving itself into a services center. And here, what has been contributing to the services trade surplus, it is one that stands out is in the area of finance and insurance. The surplus has actually been increasing, and the average of 2020 to 2023, actually, the surplus stands at around 6%, which also reflects the growing stature of Singapore's position as an international financial center. And if you look at the Global Financial Center Index, Singapore is actually top in Asia and third globally, just behind places like New York and London. So I think Singapore as an international financial center has been really growing quite well. Secondly, I think beyond just the modern services and finance and insurance that has done quite well, Singapore has also benefited from its traditional services. And that is in the area of transport, where we see the surplus has also been increasing to 2%. Also, what we have seen is that maintenance and repair has also been registering surpluses. So Singapore, I think, has continued to play up its strengths in terms of its strategic location in the region, whether it's for its port or for its airport. And here we have seen also the nice recovery from the pandemic in terms of recovering tourism arrivals, as well as in terms of container throughput. Singapore is one of the top ports globally. So I think these strengths has certainly helped the transport surplus. And I think Singapore continued to build its competitiveness and not resting on its laurels. So I think recently you may have seen in the news that Changi Airport is going through expansion, and in the first half of 2025, we will see Terminal 5 construction beginning, and in the mid-2030s, we can expect capacity to rise by another 50 million from the current 90 million that Changi Airport can service in order to maintain its position as a aviation hub in the region. Secondly, Tuas Port is also upgrading, and in the 2040s, we will see a full completion of the Tuas Port, which will ensure Singapore's competitiveness as a transport hub. So lastly, for the live stream, I would like to touch on the National Day Rally 2024 highlights, which is the very first rally by Prime Minister Lawrence Wong since he took office as the Prime Minister in May. So this National Day Rally, I think, really reflects the continuation of the Forward Singapore agenda that's being set up by the 4G leadership team. So in his National Day Rally, he focused on 4 key areas to try to build a more inclusive Singapore and ensure inclusive growth. So these 4 areas are, I think, first and foremost, today we talk about the economy. Economy and jobs is also top of agenda for the leadership. Secondly, in terms of families. Thirdly, on housing. And then lastly, on education. So firstly, in terms of jobs, I think for quite some time, the Singapore government has been quite against unemployment benefits. But I think in this rally, what we have seen is that they have come up with an enhanced version of employment benefits. So what they have announced is the Skills Future Job Seeker Support Scheme, which should basically provide up to $6,000 over 6 months period for those that are involuntarily employed. But this comes with conditions that you either have to be searching for jobs, engaging matching services with the various agencies, or going through some form of reskilling to receive this financial support from the government. So in that sense, if you're making an effort to try to rebound and return to the labor market, the government would lend a hand in terms of financial assistance. Secondly, just now I talked about the really high competitiveness of the Singapore economy. But even then, the Singapore government is going to undergo a review to try to ease business regulations, particularly in terms of helping SMEs. Secondly, in terms of families, what we have seen is that Singapore's fertility rate has been dropping below 1, in fact, in 2023. And I think over the past couple of budgets, there have been quite some pro-family policies that's being rolled out, and the rally announcement is really an addition to that. So other than making paternity leave compulsory on a 4-week basis, there will be an extra 10 weeks paternity leave. But I think the government has introduced a 2-phase rollout, considering the challenges that employers might face in terms of manpower. So this is really helping families, but also allaying and balancing some of the concerns on the employer side, given that Singapore still has a reasonably tight labor market conditions. Thirdly, in terms of housing, I think there's still quite strong commitments in terms of rolling out new HDB supplies. We have seen HDB prices rise quite a bit, but at the same time, the government is ramping up supply on this front, especially to catch up with the pandemic backlog. So they are quite on track in terms of rolling out this supply, and by end 2024, you would see them build additional 80K new flats. 20K is expected for 2025. And lastly, I think not just in terms of affordability, accessibility is also being addressed, where the certain grants are also being raised for lower income. And lastly, in terms of education, I think Singapore's education is already top ranked, but there are certain areas that's being done to improve education opportunities, and there are 2 areas that are being tackled, especially in the gifted program, as well as in the areas of mother tongue. So 5 key takeaways from my sharing on Singapore. So firstly, Singapore's economic growth is improving in 2024. We should see the growth rate return to its potential growth of 2 to 3%. Exact forecast 2.7% for 2024. And this is also reflected in the resilient third quarter growth that's sort of expected and reflected in our nowcast. What are the drivers? External-oriented sectors are going to support the recovery: manufacturing, trade-related services, modern services, including finance and insurance. We also touched upon the sustained currency appreciation pressures that we have seen in recent years, and these are really being backed by robust FDI inflows that we are seeing coming into Singapore, as well as the high current account surplus, but with 2 shifts that we are seeing in terms of the primary income deficit, which reflects again the FDI inflows that are coming in, as well as the growing services trade surplus, which is something to watch out for. And lastly, I think PM Wong's very first National Day rally speech unveiled quite a lot of policies for inclusive growth, and where the new leadership really wants to take Singapore forward in its next chapter of Singapore's journey. So now, let me point you back to the pigeonhole questions, and welcome Tamer back to our live stream.
Thank you, Han Teng, for such a small open economy, so much going on. And I want you to stay with Singapore a little longer, because the first question that I want to pick on the screen is about the downside risks to Singapore. So we will go to Pigeonhole, but before we that, just remember dbs.pigeonhole.at, passcode macro, if you have any lingering final questions, but we already have a lot to cover and only about 6 minutes to go. So Han Teng, what are the key downside risks faced by Singapore's economy? Is it Trump?
just now I was sounding very optimistic about the growth outlook. We didn't really touch about downside risk, but really one downside risk that I think I really wanted to point out is the evolving geopolitical tensions that's happening globally, whether it's a Russia-Ukraine war or the Middle East conflict that's happening. So I think that has caused quite some supply chain disruptions during the 2022 period, especially for Russia and Ukraine. So one thing that I observed in the electronics PMI numbers, just now we are saying that it looks quite optimistic, but one component which I think our viewers will be interested to hear is that actually supplier deliveries are still in contraction. So I think perhaps still reflecting some form of adjustments to, say, supply chain disruptions, for example, the Red Sea crisis. So perhaps that's one area that could be a downside risk to, say, the manufacturing improvement. And I think since today, we also saw the release of the MAS Professional Forecaster Survey. I think one thing that stood out from the survey to me was that inflationary pressures was something that was mentioned in the previous two surveys, but not mentioned in this survey. So maybe that's something that I think you shared, which we can point to some comfort at the very least.
Right, so the inflation story is complicated and multifaceted now. So on one hand, we have the Singapore dollars appreciating sustainably against the US dollar, dropping below 130 in the past couple of weeks. And at 130, I would think that it imparts some degree of disinflationary impulse to all the imported items that Singaporeans consume on a day-to-day basis. But also you could argue that a period of very strong dollar could have other implications for Singapore. Maybe inflation is not a problem, but then retail sales all migrating across the border could be the issue, because it's much cheaper to buy there than here. So with Singapore putting all its monetary policy eggs in the exchange rate basket, that is the lever that the country uses to fight inflation. Sometimes you wonder, what about the second round, third round impact of that? And can some of those things, initially intended as a positive thing, creating an upside risk, lower inflation, but create second, third round effects, which are downside risks, such as weakness in labor flows or weakness in retail sales. Han Teng, I do want to flag, although I think the question was about the short term, and also you correctly answered the question in the short term context, but there is a long-term ticking time bomb, which is aging, which is something the government talks about a lot in its policy speeches, but some of the numbers are absolutely stark. 10 years ago, 1 in 5 Singaporeans were, or less than 1 in 6 Singaporeans were over 65. Today it's 1 in 5. By 2030, it'll be 1 in 4.
Yes.
So it's aging very rapidly.
Yeah, so I think it's going to reach super age status by 2026, which is certainly something that is
just explain to our viewers what super age status means.
So I think the UN basically defines it as if your proportion of population that's above 65 above is above 21%, then you'll be considered super age status.
Correct.
So that's certainly one drag to the Singapore economy over a long term. And I think in PM Wong's speech, he's been, I think, trying to address that in terms of reversing the fertility rate problem.
Right.
But I think longer term problem or challenges can be also in terms of the growing constraints, whether in terms of land, labor, and therefore I think that's where, the Johor Singapore Special Economic Zone also comes in, right?
Absolutely. Okay, we only have 2 minutes left and lots of questions to cover. We will not be able to do it. Han Teng, there was a question on Philippines and the outlook. Sorry, no time for that. There was also a question about Indonesia, opportunities and challenges there. That would require a whole seminar. So watch out for that. Radhika Rao, Indonesia economist, does outstanding work. Some of the stuff about Indonesia's medium-term opportunities have been mentioned in the collaboration with Bain & Company that we did, which you were also part of. So we do a lot of work on Indonesia. We're not going to talk about it today. There are 2 questions. Let's see if I have the time to go over them really quickly. Question 1, I got to press answered. And now I have to select this question. You say equity markets are complacent. Would you say LT, long-term US Treasury bonds, would be a good place to hide? Check the TLT ETF. It has fallen 42% since 2020. It is also up substantially in the last couple of months as the market has begun to price in rate cuts. So I would say that there's probably still some juice left in ETFs like that. But the real time to take positioning was when the market basically assumed the Fed had capitulated, and you probably have lost maybe about 8-9% of the upside along the ride up. But still, it's an interesting option, no question about it. And I will spend the last 60 seconds talking about something very interesting. I wish Radhika was here, but I will take it on. What is your outlook on India's rice export ban? Will they finally lift this? Okay, so quick context for everybody. About a year and 1 month ago, July of 2023, India imposed a ban, but not on all rice. We in Singapore still enjoy the long grain basmati rice of India, no problem with that. It's the non-basmati rice India ban, probably with election in mind, probably with bad weather in mind. Turned out, weather was fine, Indian rice stocks are fine, and despite all those measures, I don't think the authorities got their hoped-for bump in the election. Nonetheless, it has been around for a while. I do think a few measures in terms of reducing support price and others are in store. Don't worry about it. Rice price is not a problem. Even India's ban did not cause a massive consternation in global rice prices. Some upside, but not the end of the world. I think there is ample supply of food in the world, and even India is coming around. Don't worry. We're going to end right there. Thanks to everybody. Thank you, Han Teng. And thanks to our colleagues at GSMC Spark Studios who helped us produce this thing. We will come back to you next month, and we will be getting very close to our annual outlook as well. Watch out for that. But until then, stay safe, stay healthy, everybody. Bye-bye.